Gold is not just a commodity. It is a barometer of global fear and confidence, a store of value and a financial weather vane that tells us where markets think risk is heading. Right now, gold is making headlines for all the right reasons and all the wrong reasons. It has reached record price levels. In fact, prices recently hit a historic high above $5,000 per ounce in early 2026. This isn't just a fluctuation. It's part of a trend that has been unfolding over the past couple of years, driven by deep macroeconomic shifts, geopolitical tensions, and a search for security in uncertain times. So let's talk about what's driving gold right now, what that means for the average person, and how you should think about your money in this environment. Not as a get-rich-quick scheme, but as a strategic financial decision. First, why is gold so high? There are a few main forces at play. 1. Gold is benefiting from broader safe haven demand. When geopolitical tensions rise, trade conflicts intensify, war risks increase, or major powers signal instability, investors shift capital towards assets that are less tied to economic growth and more tied to value preservation. Gold has historically been that asset. It doesn't pay interest or dividends. It doesn't grow like a business. Instead, it protects wealth in times of uncertainty. That's why central banks across the world, from China to many emerging economies, continue to diversify reserves into gold. 2. Monetary policy is a big driver. A weaker U.S. dollar makes gold more attractive to holders of other currencies, since gold is priced in dollars. As the dollar softens against other world currencies, gold becomes cheaper for foreign buyers and more desirable. This interplay between the dollar and gold is one of the reasons gold's momentum has been strong, even as traditional assets like stocks and bonds face pressure. 3. Central banks themselves are major participants, not just retail investors. Institutions that normally hold government bonds or dollars are buying gold to diversify. That structural demand underpins much of the current price strength and helps explain why gold has risen so dramatically. Now, let's be honest about valuation. At these levels, gold is both exciting and intimidating. When prices surge rapidly, it naturally leads some people to ask, is it too late to get in? We hear that question all the time, and today, that question is more relevant than ever. The short answer is, no asset can guarantee returns, and gold is no exception. We've also seen moments of sharp corrections, significant pullbacks in price, sometimes triggered by macro news or rapid shifts in sentiment. In fact, there was a recent episode when gold and silver prices experienced noticeable declines, and markets had to intervene to limit volatility. That's important. Just because an asset has a strong long-term trend doesn't mean it won't fall hard in the short run. Gold can be volatile, and it can certainly overshoot on both the upside and the downside. So what should you do? The regular person with savings, bills, goals, maybe a family and long-term financial aspirations. Let's talk real strategy. Not fantasy. Point 1. Understand what gold is and what it isn't. Gold is a store of wealth, not a growth engine. It's not a business that earns profits. It's not paying dividends, and it doesn't double your money because of internal cash flows. It holds value when faith in currencies or markets weakens. That's why investors hold it as part of a broader risk-diversified portfolio. That's also why gold is often valuable when inflation is high, when currency weakness spreads, or when geopolitical shocks hit. It's a risk hedge, not a yield generator. For ordinary investors, that distinction matters. You wouldn't put all your money into gold expecting it to grow like a tech stock, but putting some money into gold because you want to hedge against risk, that's sensible. Point 2. Don't chase the top and don't panic at corrections. One trap a lot of people fall into is emotional timing. You buy when prices are high because you don't want to miss out, and you sell when prices drop because you don't want to lose money. That's how people transform temporary volatility into permanent loss. If you buy gold, do so with a plan. If you buy it today at elevated prices, understand that prices could retrace. If you see dips, those can be opportunities to add modestly, not panic sales. Think of your entry and exits as part of a long-term risk management framework, not a sprint, but a marathon. Point 3. Allocate only what you can comfortably hold. For most people, gold should be a portion of your total investment mix, not your entire portfolio. Financial planners often suggest a modest percentage. Enough to hedge against inflation and currency risk, but not so much that a downturn would jeopardize your financial goals. Think in terms of balance. Stocks for growth, bonds or equivalents for income and stability, and gold for diversification and protection. Just like you wouldn't spend all your retirement savings on one stock, you shouldn't put all your savings into gold. It's a component, not a replacement for diversified investing. Point 4. Consider practical ways to invest depending on your situation. There are different routes to gold exposure, and each has its own implications. Physical gold, bars, coins, jewelry, is tangible and familiar, but can have higher storage and insurance costs, and buying-selling spreads can reduce returns. Gold ETFs or funds, these trade like stocks and provide liquid access to gold prices without storage hassles. Gold mining stocks or funds, these can offer leveraged exposure, but also come with equities company-specific risks. Digital gold platforms, in some markets, you can buy gold fractions digitally with lower entry costs. Choose what aligns with your risk tolerance and your investment horizon. For instance, someone wanting generational wealth might prefer ETFs or diversified funds. Someone seeking a store of value might allocate a portion to physical gold. Whatever route you choose, make sure you understand the fees, the tax treatment, and the liquidity of what you're buying. There are no shortcuts in investing. Point 5. Think long-term and use gold as a strategic anchor, not a speculative gamble. Gold shines brightest when it complements a well-constructed plan. It has protections that bonds or cash sometimes lack, especially in environments of geopolitical uncertainty or currency instability. But remember, gold does not grow because it's shiny. It holds value because people value stability, and because markets use it as a refuge when uncertainty rises. So if you decide to allocate a slice of your portfolio to gold now, don't view it as a way to get rich fast. View it as a way to protect and diversify. When that mindset shifts, you stop chasing peaks and reacting to every headline. You build resilience into your financial future. Point 6. Be adaptable. Markets change, and so should strategy. Yes, gold is strong now. Yes, some forecasts see prices continuing higher into 2026, even with volatility. But that doesn't mean the trend will be perpetual or uninterrupted. The market will have corrections and risk events. There will be times when gold underperforms other assets, and times when it outperforms dramatically. The key for the regular investor is not to predict every turn, but to be prepared for many scenarios. If gold rises, your strategic allocation protects purchasing power. If gold dips, you can accumulate more gradually without fear. If global conditions normalize, other assets may outperform and gold stays stable. This kind of balanced thinking is what separates long-term financial success from short-term speculation. Let me close with this. Gold today is not a rumor. It's a reflection of a world that is uneasy, economically, politically, and financially. Prices high or low, gold represents human choices, caution, preservation, and long-term thinking. If you choose to invest in gold, do it with clarity, with balance, and with a plan that fits your life, not someone else's fear. Invest smart, diversify wisely, and don't let the noise dictate your money decisions. Because real financial success is not about chasing trends, it's about building stability and resilience no matter what markets do next.